Hello. Very good afternoon, everyone. Am I audible? Clearly audible to you? Just let me know so that I can proceed. Anyone? Yes? All right. Thank you. Okay, so welcome to this session of MCQs. In today's session, we'll be discussing the previous year questions of your SEBI phase 1, phase 2 examination, which have been asked, right? Previous year, the latest question paper I am talking about, okay? So it would be interesting to see how questions are framed, what are the topics which finds place in these question paper. Okay, all right. So let's begin, and I would appreciate your active engagement. Just try to answer the questions. All right. So this is your first question here. This is your first question. Which of the following is mandatory for GST registration? So the question is asking which of the following is mandatory for GST registration. Okay. All right. Okay. Aadhaar, PAN, DMAT, none of the above, all of the above. Okay, your answer is PAN, of course, PAN, right? So your PAN, permanent account number, is mandatory for GST registration. Okay, Aadhaar is not mandatory. Aadhaar not mandatory, remember. Okay, although Aadhaar can be used in some type of registrations, but it is not mentioned as a mandatory document to register yourself or to gain a GST IN. Okay, so PAN is something which is mandatory for GST registration. So after registration, you get a GST number, right? GST number, and that number is of how much digit? GST number has how much digits into it? Anyone? Does anyone know? So yes, here your right answer is B, PAN. How many digits are there in your GST number which you get after registering? Anyone? 15, very good. Prashant Sharma, yes. So you get a 15 digit GST IN. Okay, and every digit has its own importance. Okay, you can read about it. So this is your first question. Remember, all these are previous year questions only asked by SEBI. Okay, so you can find out the areas which are important. Second question, no idea? Then have an idea. The idea is 15 digit. Okay, now question 2. Question second, very interesting question. What does DTAA stand for? DTAA stands for Double Taxation Approved Agreement, Direct Tax Appraisal Agreement, Double Taxation Avoidance Agreement, or Direct Tax Avoidance Agreement, or none of the above. Question number 2. Question number 2. Okay, here we have the answers. Prashant C, Piyush C, Gurleen C. Very good, very good. So you are saying Double Taxation Avoidance Agreement. Yes, actually this is the right answer. Okay, this is the right answer, DTAA. Okay, you know the full form, but do you know what is Double Taxation Avoidance Agreement is? It holds a very important role in nowadays international relations and taxation policies as well. Do you know what is Double Taxation Avoidance Agreement? Anyone knows that? Don't worry if you don't know. Avoid paying double tax, treaty between two countries. Yes, as the name suggests, avoiding paying double tax. But what is the double tax which we are talking about? Is this double tax on the same person in the same country, or double tax on the same person for the same economic activity between two countries? Avoid double tax for FPI investors, treaty between two countries. Yes, Prashant, this is the right answer. So this is basically a kind of tax avoidance agreement. Let me explain it to you. All your doubts will get cleared. between two countries. Yes, yes. Okay, so now let me explain. What is double taxation avoidance agreement? So here you have DTAA, okay, double taxation avoidance agreement. See, first of all, understand what happens is you have MNCs, multinational companies, right? And you know very well that MNCs are increasing their sources of money by, establishing their presence in almost every country or say major economies. Are you getting this point? So it might be the case that say one MNC which is registered in US or it belongs to the US is also earning from India. Yes or no? Right? So in that case, what happens is sometimes companies, MNCs have been reported to evade taxation. Suppose, so this is known as base erosion. Base erosion. Have you heard about base erosion? This is also very important. There is something called base erosion and profit shifting. BEPS and profit shifting. Base erosion and profit shifting. So this is an important problem which we are right now facing to track the taxation source. Are you getting this point? What is base erosion? So first let me tell you what is a base. What is tax base? Anyone? Any idea? What is tax base? What is tax base? Tax base is basically the income or the people who are taxed. Okay. On what percentage of or on what income slab are you imposing the tax? That would become the tax base. Okay. So tax base is the base on which tax is calculated simply, right? So what happens is companies are actively indulging into tax avoidance. There are two things. You can save your tax, okay, or you can plan. So tax planning, tax saving, but there is something called as tax avoidance or tax evasion, right? So that is illegal. That is illegal, although you can plan to save your taxes according to the clauses provided in the Income Tax Act only. For example, you have a section. Can you tell me which section I am going to talk about, which gives you a very important provision for tax planning? Which section of Income Tax Act is there? The most famous section of Income Tax Act. Anyone? So it is 80C. 80C. Section 80C, yes. Section 80C of Income Tax Act provides that if you put around 1.5 lakh rupees in your PF account, okay, that would be non-taxable. So this is how you have some legal clauses through which you can plan your taxes to save taxes. But evading the taxes is illegal. It creates loss to the government coffers, isn't it? So what companies do, for example, say there is a company X, okay, suppose there is a company X. Company X is basically based in US, but also earning from India, okay, but this company is trying to evade the taxes, say from India or levied by Indian government or Indian Taxation Department by saying that we do not earn any profit from India, okay, or they might show their profits from some other countries which are tax havens. What are tax havens? Even if they are operating in India, they might show losses that, okay, we are running in losses from India, for example, and they might show their profits from such a country which is a tax haven. What is a tax haven? Tax haven. Tax haven nahi pata? Tax haven is a country where tax laws are very lenient, or say the tax rates are very nominal. For example, you must have heard about the Panama Papers and all these things. Why everyone wants their bank account to be there in the Swiss bank? Yes or no? You have heard about it? Yes? Right? So, Switzerland, for example, tax haven country. Yes, tax haven. Okay? It is not H-E-A-V-E-N. That haven is some different haven. Yes, very good, Nikhil. So these are some tax havens. There you have nominal tax rates or very lenient taxation system or laws, right? So what happens is these type of companies having different tax bases or different offices in different countries, they try to show their profits from such a country which is a tax haven, right? So that they do not have to pay huge taxes, and they erode their tax base from major taxation countries like India, so that government of India cannot tax them. So this is known as base erosion. You have eroded your base. You are not showing profits from India even if you are earning profits from our nation. Yes or no? So this is eroding of the base. Profit is the base on which government wants to levy the tax. So you have eroded the base only. How would we be able to tax you? Are you getting my point? So this is what companies were doing. Okay, so every country wanted to avoid this situation so as to avoid the losses to their coffers. Okay, but in the same solution there became a new problem, or a new problem originated, that sometimes in order to tax those companies from all the sources they are making profit from, what happens is some companies, some investors or individuals end up paying double taxes for the same activity. Double taxes for the same activity. For example, they have paid the tax for same activity in US as well, and paid the tax in say India as well. So that is known as double taxation. Have you understood what is double taxation? So what countries have decided to have agreements. So these are known as double taxation avoidance agreement, so that the companies, the MNCs, the individuals, investors also don't have to pay double taxes, and so that the government also do not incur losses. So they are trying to find a solution in between. This is what double taxation agreement is, and India has signed double taxation agreement with almost all the major countries. Is this clear to you all? Let me know. Double taxation avoidance agreement and the background behind it. Yes? No? Yes? All right. Very good. So this is what is double taxation avoidance agreement. Okay. Then you have your third question. Yes, very important, very interesting, related to RBI. Who among, oh sorry, I told you the answer only. Who among the following is considered as lender of last resort? Okay, let me know the answer. Prashant, Matthew, Snehal, very good, very good. D is the right answer, RBI. Okay, so lender of last resort. You must all know that RBI is known for certain functions. Can you quickly name the functions of the RBI, the famous functions like lender of last resort, like banker to the bankers? Yes or no? These are certain famous functions of the RBI, right? Can you name a few other than this? Okay, that is a function, that is CRR, SLR, repo, reverse repo, OMO. See, Prashant, that is monetary policy tools, okay? CRR, SLR, OMO, all these fall under the quantitative measures taken by RBI. In monetary policy, we are talking about the general functions of RBI. Forex management, yes. So, RBI is famously known as banker to the bankers, okay? That means, like we, for common people, commercial banks are the banks, right? And for commercial banks, who is the bank? RBI is the bank. Yes or no? Currency issuer, bankers bank. Yes, bankers bank. So we have to borrow money, we go to the commercial bank. You know that public, common man directly cannot take loan from the RBI. Yes or no? Right? So we have bank in the form of commercial banks. But for commercial banks as well, we have something or some entity which is the banker to the commercial bank. So that's why the function banker to the banks. Okay, and that's why you have this function as well, lender of last resort. So what happens is, when we are in liquidity crunch, we run to the commercial banks to demanding loans or credit. What happens if commercial bank is in a liquidity crunch? For example, a commercial bank was doing good. Suddenly there arises some crisis and the bank needs funds. So where will the bank go? Bank will go to the RBI. So RBI saves the bank from such crisis. So as the last option, what what helps the commercial banks in coming out of such situation or crisis is the Central Bank of India, which is RBI. That's why it is this function of RBI is known as lender of last resort. So as the last option to the commercial banks, when they do not have any other options left, it is the RBI which comes into the picture and saves them from insolvency and bankruptcy. Is this clear? So that's why RBI is known as your lender of last resort. Okay. Now, next question. Working and, tell me the answer, working and operations of NBFCs are regulated by RBI, SEBI, DICGC, Ministry of Finance, none of the above. Yes, very good. RBI is the right answer. Yes, so A will be the right answer for this question. Why? Because according to the RBI Act 1934 only, NBFCs operations and working are regulated by your Reserve Bank of India. What is an NBFC? Non-banking financial company. You all know about NBFC, right? What is NBFC? Non-banking financial company. But what is it? So it is basically a type of financial institute which works almost like a bank but is not a bank. Okay, so NBFC do not have banking license, first of all. Then what is the difference between bank and NBFC? First thing, bank can accept. So NBFCs are there, financial institutes which are there for lending activities. They can give you loans, but they cannot accept, first thing, demand deposits. There are 2-3 differences between NBFCs and commercial banks, which you should remember. Only lending, not deposit. Yes, Prashant, but there is a glitch here. Ma'am, but will it not be only for banking operations? Cannot accept demand deposits? Yes, it cannot accept demand deposits. Banking operation, you cannot say that NBFC works as a bank. No, there is a difference between a bank and NBFC. Okay, NBFC by definition is non-banking financial company. So it provides other financial services like lending activities, but it is not a bank. Why not a bank? Broadly 3 differences. Let me tell you. Broadly 3 differences are there between NBFC and bank. Broadly 3 differences. What? Bank can accept demand deposits. Okay, demand deposits, your saving account and all these things, the money which you can withdraw on demand anytime. Okay, so there is no lock-in period. But NBFCs cannot accept demand deposits. First thing. SEBI also regulates NBFCs too. Yes. So see, when regulation of NBFCs comes into picture, NBFCs belong to different sector. For example, infrastructure sector, for example, finance sector. So sometimes the regulators of these insurance, so NBFC related to insurance sector will also be regulated by your Insurance Regulatory Development Authority, IRDA. Are you getting my point, Gurleen? Okay. So depending on the sector to which NBFC belongs, there are those regulators as well, but overall the functions and operations are regulated by the RBI. Okay, so in infrastructure you can have other regulator, in finance you can have other, in say microcredit you can have other, in every sphere. So this is the situation. Issue checkbook, then NBFCs cannot create money. Yes, see, I am telling you the basic differences, you just remember these things. First, cannot accept demand deposits. Second, do not form a part of your payments settlement system. Do not form a part of your payment settlement system. Payment settlement system. Got it? What is your payment settlement system? All these things like RTGS, NEFT, okay, IMPS. So it does not form a part of your payment settlement system. Third, can you tell me? There is a question also which has been asked, I think in SEBI only or some other examination, that NBFCs deposits are not insured by your DICGC. Deposit Insurance and Credit Guarantee Corporation gives insurance on bank deposits, right? But it does not give insurance on deposits with NBFCs. This is another difference, okay? So, no deposit insurance, no deposit insurance, no deposit insurance by DICGC on NBFC deposits. Is this clear? And one thing, they can accept term deposits, but they cannot accept demand deposits. So you cannot say they do not accept deposit clearly. No. NBFCs accept term deposits. So they can accept all those deposits which are there for at least 12 months. The period of such deposit should be at least minimum 12 months, okay, and maximum, if I am correct here, would be 60 months if I am right, okay. You can check it. So minimum 12 months and maximum 60 months you can yes, deposit not guaranteed by DICGC, okay. Can accept term deposit, yes, of course, minimum 1 year, 12 months, but maximum is not, yeah, so maximum 60 months, okay, 1 to 5 years. Is this clear? The difference between NBFC and bank? So you should remember these major differences, okay. Now, next, BPO, easy question, isn't it? Tell me, what is BPO? What does BPO stands for? C, business process outsourcing, business process outsourcing. A, business processing office. Is it clear now? Am I audible? Audible now? Okay. All right. So, BPO is what? You have heard about call centers, right? So, some product manufactured in say US, and the information, the customer services provided by say people, fluent English speaking people from say some parts of India. Yes or no? So, this is outsourcing of your business. Or some parts of say car manufactured in India, some in China, and final assembling is happening in say US or say some European country. So, this is your business process
चार्ज नहीं है ना, सॉरी चार्ज हो रहा है।
Audible now? Let me know. Yes, okay. All right. So we were discussing about BPO. So I was telling you that BPO is what? Business process outsourcing. You have heard about call centers, right? And you know that there is a huge middle class in India. They are fluent in English, educated, right? So they provide these services to some MNCs as well. And there might be some automobile company manufacturing tires from some country, say from MRF, okay, your Madras rubber factory, assembling the parts somewhere else. So this is your business process outsourcing, right? So C is the right answer. Sixth question: which organization play important role in promoting financing and development of MSME? Yes. What is the answer? Yes, B. B is the right answer. MSME financing and development promotion primarily lies with your SIDBI, Small Industries Development Bank of India. Yes, this is your right answer. Small Industries Development Bank of India. You all know that this is very important sector having prominent importance in government's policy making nowadays. MSME, the micro, small and medium enterprises sector. We have also discussed the features of MSME in one of the editorial analysis, if I am right. Okay, I have given you the difference in the table via mudra. Yes, yes. Okay, so SIDBI is the right answer. All right, Small Industries Development Bank of India. Then the next question is law of demand means. So this is again your previous year question only. Law of demand means what? Given the options, tell me the answer. A, B, C, D or E. Law of demand. Income increases, demand increases, price of good falls, demand falls, price of related good, price of the good falls, quantity demanded increases. D. Very good. You should not be wrong on these basics, right? So law of demand, simply inverse relation between price of the own good and its quantity demanded, other things remaining constant. Yes, very good. Answer of 7th question is D. D is the right answer. Then you have CBDT. CBDT. What is CBDT related to? Tell me the answer. What is CBDT related to? CBDT. So your answer is C, direct taxes. Okay. Direct taxes. Very good. Very good. So CBDT is what? CBDT is basically your Central Board of Direct Taxes. Central Board of, yes, Central Board of Direct Taxes. It is basically, it works with the income tax department, as you know. It formulates the laws related to your direct taxes, gives guidelines and ideas to your income tax department, right? So it is basically responsible for your direct taxation in India. All right. So Central Board of Direct Taxes. Therefore, the answer is C. What is the direct tax? We have discussed the difference between direct tax and indirect tax. What is the direct tax? The burden of which cannot be shifted to someone else. Yes or no? Right? Burden of which cannot be shifted to others. And in indirect taxes, you can shift the burden. Corporate tax, income tax. Yes, this is example of direct tax, but I am asking you the definition. How do you classify a tax as a direct tax or as an indirect tax? So indirect tax, the burden can be shifted from one person to another. But in direct tax, you cannot shift the burden. If the tax lies on you, you only have to pay the tax. person directly pays. Directly pays what? Yeah, so basically, you are trying to say that, okay, for example, in indirect tax, the producer has paid the tax while producing the product, and you pay it in the form of MRP, right? So the taxes are hidden in your MRP. So this is the difference. I have again and again told you the difference between a direct tax and indirect tax. Direct tax, the burden cannot be shifted. The person who has been levied with the tax will only pay the tax. But in the case of indirect taxes, you can shift the burden. Yes, very good. So this is your CBDT, responsible for direct taxation in India, works with your income tax department. Okay. Then next, question number 9. Question number 9. Which of the following is not a method of quantitative control by RBI? Very important question. Tell me the answer. Okay, options are not visible. Not a method. So, which is not a quantitative tool basically of RBI's monetary policy? All right. These are your options: A, B, C, D, E. What is the answer? Not a quantitative measure taken by RBI. Everyone is saying E. Okay. Are you sure? E is the right answer? Or D? E or D? Yes? You're sure? Very good. You should be confident with your answer, right? Okay. So, yes, E is the right answer here. E is the right answer. Credit rationing. You all know that there is something called monetary policy of RBI. Yes or no? Right? Monetary policy's aim is to control money supply or to regulate, change money supply according to the inflationary situation, so that final aim is to contain the inflation within the desirable bracket, within the desirable limits. What is the desirable limit? What is the desirable limit of inflation in case of India? Tell me quickly. What is the desirable limit of inflation in case of India? 4 plus minus 2%. Very good, very good. 4 plus minus 2%, right? So RBI tries to manage this desirable bracket while changing the money supply. So for that, there is something called as monetary policy, and you all know that in monetary policy of RBI, we broadly classify the tools as quantitative and qualitative. Okay, so in quantitative you have CRR, SLR, repo, reverse repo, then your open market operations, marginal standing facility, and recently one new quantitative tool has been included. Which is it? Can you tell me? It has basically replaced the reverse repo. Which one is the newest? Yes, very good, very good. Standing deposit facility rate. Standing deposit facility rate. Standing deposit facility rate. Replaced RRR, reverse repo rate. Clear? So, these are your quantitative tools. But there are certain qualitative tools like guidelines, okay, which are used by RBI. So, direct action, moral suasion, credit rationing, all these things fall under the category of your qualitative tools. Qualitative tools. Moral suasion, okay, direct action, then you have your credit rationing, etc. What is credit rationing? Basically, credit rationing word, you must understand that rationing is what? When you try to limit the quantity of something, okay. Credit rationing would mean you are limiting the credit extended to the public. It may be due to inflationary conditions, okay. It may be due to high risk involved in extending that particular credit. It may be due to lesser availability of credit for others. Anything can be the reason, but credit rationing is simply you're limiting directly the credit, yes, restricting the amount which goes as credit into the economy, right? So these are qualitative tools, hence credit rationing is a qualitative tool. Is this clear? You should remember this thing. Standing deposit facility rate, new quantitative tool incorporated by RBI. Okay. Okay, so here your answer is E. E is the right answer. Then question number 10. What is a monetary base? Okay, tell me. What is a monetary base? What is a monetary base? Your answer is C, D, C. C is amount of cash circulating in the economy. D is money supply in the economy. Okay. So some of you might be confused between money supply and monetary base. These are two different things. Okay. Remember, I would explain you the difference. So from now you will not be confused between these two terms. Okay. Yes. Cash in circulation, right? So what is monetary base? See, monetary base is basically your amount of cash circulating in the economy. So what is the currency in circulation? But then what is money supply? Money supply also sounds similar, isn't it? Right? Money supply is also the currency in circulation. Then what is the difference? If you see the definition of money supply, somewhere you will find that it is the total money in circulation at a given point of time. So it is a stock concept. Okay. Stock is basically when you measure a variable at a point of time. So we say that money supply is how much currency in circulation at a point of time. So it is a stock concept. Other one is flow, that you are measuring a variable during a period of time. That becomes a flow concept. Are you getting this point? So then what is the difference between a monetary base and money supply? It is simple. It is simple. Just try to understand that when we say monetary base, it would mean your currency held by the public, first thing, and the reserves with the banks. Are you getting this point? So broadly two things. Currency held by the public. So currency means your coins and bank notes as well. Okay. And money supply is also currency in circulation, but it has all types of bank deposits. It is less liquid than monetary base, you can say. Are you getting my point? So monetary base deals with more of the liquidity part of currency in circulation. So your money supply also has term deposits, which are not so liquid. Are you getting this? So monetary base is more related or more concerned with your liquid or cash part of the currency in circulation, while money supply has all your reserves. So you have money supply as M0, M1, M2, M3, M4, all the measurements, all the aggregates related to money supply. So they have those type of deposits as well, which are not liquid, which are not easily convertible to cash. Are you getting it or not? So is this difference clear? So that's why we can say monetary base is more related to liquidity in comparison to money supply. Got it? Although there are similarities between them, components might be similar, but it has to do more with the liquidity. Monetary base has to more to do with the liquidity. Clear? Okay. All right. Next question. I would appreciate if I get the right answers. Okay. Very interesting question. Very interesting chapter. National income is something. So here your answer will be C as the right answer. Is it clear to everyone? Just let me know. Nikhil says got it. Okay. What about others? Clear? Okay. Now tell me the answer of this question. Tell me the answer of this question. Calculate NNPFC from GNPMP. This is from your national income. Okay, national income. Have you read or covered the syllabus of national income? If you have done it, then it would be easy for you. Okay, so you are saying B. Okay, tell me honestly, do you know the answer? Or are you referring from somewhere? You know the answers, yes? I'm happy to see that. That's why I'm asking. Everyone knows the answer, right? Okay, very good. Then it is okay. So calculate NNPFC from GNPMP. For all those who don't know what is asked in this question, I'll explain it to you. Don't worry. B. You are saying B. Subtract depreciation and net indirect taxes both. Okay. Yes, very good. So see, these are certain aggregates which are related to your national income calculation. Okay. Okay, Ramesh Singh, Indian Economy, Chapter 1 में formula है. Net means always subtracted from gross. Yes. Understand this. So, question is asking you to convert NNPFC from GNPMP. Okay, GNPMP. So, you have to derive NNPFC. First, you tell me, first of all, what is NNPFC? Is this the national income of your country? Yes or no? What is NNPFC? Net national product at factor cost. And do you understand these aggregates? What do they mean actually? You don't have to just mug up the formula. You should know the rationale behind them, right? Net means always subtract. Yes, national income. So when we say national income, the exact aggregate which represents the national income is NNPFC. First of all, you should remember this, okay? So NNPFC is your exact national income. What do you call as your national income? Okay. So whatever aggregate is given to you, be it GDP, be it GNP, be it NDP, NNP, you can always derive national income from all these aggregates. You just need to know some of the basic concepts, right? For example, first thing, the difference between G and N is always of depreciation. Okay, first thing, gross and net में there is always the difference of depreciation. Depreciation is when with the use of a particular good, its value depreciates over time, right? So gross includes depreciation while net does not include depreciation. First thing which you should remember. So whenever you want to convert G to N, you have to deduct depreciation, right? And whenever you want to have net to G, or you have to find out G from net, you have to add depreciation. Is this clear? First rule, right? So G and N is clear. G has depreciation and does not. Okay. Then second is your DP and NP. That is domestic product and national product. Domestic product and national product. What is the difference? Can you tell me between domestic product and national product? By telling the source of question. By telling the source of question. What is the difference between domestic product and national product? NFIA. Yes, see, basically the difference between them is of NFIA. Okay. What happens is, just try to understand, domestic means it is being produced within your domestic territory, within your geographical and political boundaries. So GDP is gross domestic product. So while calculating GDP, we do not calculate the net inflows or the income which we have earned from the outside or the income which we have sent to outside. Outside means outside India. Are you getting this point? So domestic product is within your territory, but when you add your net factor income from abroad, factor income, again one thing, whenever you do the national income accounting, you should remember that we always take into consideration the factor income only. Never ever is the case that we include the transfer income. And I have told you the difference between factor income and transfer income. What is the difference between factor income and transfer income? Factor income is the income which you have earned against some activity or some economic activity. You have generated some economic activity, that's why you have earned the factor income. Okay, but transfer income is funds you have raised, say gifts, the amount you have received, money you have received while doing no economic activity. Okay, for example, you visited your relatives and the relative gave you some money, okay, while you were leaving the house, which everyone wants, yes or no? Okay, yeah, remittances, remittance, gifts which you receive, grants which the government gives, donations, all these are your transfer income. Pensions, very good, very good. So, see, old age pension is a transfer income, okay, yes or no? Because you are not creating any economic activity against it right now, right? So I got it. You are clear with the difference between factor income and transfer income. So as you all know that we are open economy, we do not remain closed at all, right? So we send some income to person who is earning from India, we also receive from abroad, right? So when we take a net of it, we deduct the income from India from the income we received from outside, right? So factor income from abroad minus factor income to abroad gives you NFIA. Whatever factor income you received from abroad and whatever factor income you paid to abroad, the net of it is known as NFIA. So domestic product by definition does not have NFIA and national product has NFIA. Now what is the difference between market price and factor cost? As you all know that factors of production are there: land, labor, capital, entrepreneurship, yes or no, right? So while employing these factors of production, the producer incurs some cost. Producer has to pay rent, producer has to pay the salary, wages or compensation of employees to the labor. Yes, taxes minus, I'm coming to it, okay. I'm coming to net indirect taxes. So first you tell me that compensation of employees, wages of salary needs to be paid, right? Interest to be paid. Are you getting this point? So you have to incur cost on your factors of production. When you calculate your GDP on factor cost, on the basis of how much you have paid to them rather than the basis of the market price of your product, because after all your factor cost is going to result into market price only, right? So on what basis do you decide the market price? On the basis of your cost of production, right? So this is the difference. Therefore the difference between factor cost and market price is of net indirect taxes, NIT. So this NIT is not National Institute of Technology. This is net indirect taxes, okay? Net indirect taxes, which is to say indirect taxes minus subsidies. Indirect taxes minus subsidies. Are you getting this point? So when you deduct your subsidies from your indirect taxes and you add it to factor cost, it gives you market price. Okay, why are we deducting subsidies from the taxes? Because your market price of anything includes taxes only. It does not include your subsidies, or because it is raised, price is raised due to taxation which the producer had paid in the entire value chain. Are you getting this or not? Right? Subsidies basically try to reduce the price. If someone receives subsidy on production of something, the price gets reduced. So we want to get the net effect of it. Taxes increase the price, subsidies reduce the price. That's why we take net of it, so that we can actually examine what is the impact of net of taxes and subsidies on the market price of the product. Yes. So when we add NIT to factor cost, it gives you market price. Adding net indirect taxes, which is indirect taxes minus subsidies, only indirect taxes we are talking about. Okay. So when we add net indirect taxes to factor cost, it gives you market price. And when you deduct net indirect taxes from market price, it gives you factor cost. It is easy to remember. Taxation has to do with the market price. It does not has to do with the factor cost. So it is not included in factor cost inherently. You have to add it to arrive at market price. Is this clear? Now, let's come back to the question. So the question is asking you, calculate NNPFC from GNP MP. You should proceed step by step in all such questions, okay? It would become very easy for you. Now, first you need to know the NNPFC, okay? First thing, compare this G and N, not similar. You have to convert G into N. What will you do? Give me now give me the answers I am asking you, okay? Answers of the questions I am asking, just give me those answers. In order to convert G into N, what will you do? Tell me quickly. What taxes? No taxes. Here you don't have anything to do with the taxes, okay? Remove depreciation. I told you in the initial formula only that the difference between G and N is of depreciation. So you deduct depreciation, okay? You minus depreciation from G, which gives you N. Clear? So you have converted G to N. First step done. Second step, it is NP. National product, it is also NP. National product. So no need to convert it. Had it been domestic product here, then you would have added what to come to national product? Tell me. Had it been domestic product, in place of GNP, it would have been, say, GDP. Then what would you have done to DP to come to NP? Tell me. Plus NFIA, very good. I am impressed, okay? So NFIA plus NFIA, net factor income from abroad, gives you NP. But here you already have NP, so you need not convert it. Now what you have to do it, so GNP has become NNP, you only have to change market price into factor cost. And you already know now that the difference between market price and factor cost is of what is the difference between market price and factor cost? What do we have to add into factor cost to arrive at market price? Net indirect tax, yes, not indirect taxes. No, it would be net indirect taxes. That is indirect taxes minus subsidies. It is not indirect tax only, it is net of indirect taxes, okay? NIT, net indirect taxes. So you add NIT, that is net indirect taxes, okay? But here you don't have to add, because you have to come from MP to FC. You need to subtract it. Remember, net indirect taxes are already there in market price. You have to arrive at factor cost. So you have to deduct the net indirect taxes here. Are you getting this point, everyone? You don't have to add here. See, you have been asked to come from GNP MP to NNPFC, okay? So you have to come from MP to FC. MP already includes, market price already includes your net indirect taxes. You need to subtract your net indirect taxes from market price to come to your factor cost. Is this clear? Had it been FC to MP, then you would have added it. But here you have to minus your NIT. That's why the answer, subtract depreciation, which gave you N from G, and net indirect taxes, which gave you FC from MP. That's why this answer B is the right answer here. Is this clear? So these aggregates and their calculation becomes very easy once you are very clear and handy with your basic formulas related to national income, okay? These should be on your tip of your fingers, okay? अगर कोई नींद में से भी उठा के आपसे पूछता है कि डोमेस्टिक प्रोडक्ट और नेशनल प्रोडक्ट में क्या डिफरेंस है, so you should be able to tell that it is NFIA, right? Okay. So interesting. These questions were there for today, and that would be the set of questions for today only. It's already 4:30. We have to wind up. Okay. So these were the questions. Some of the questions from your previous years. They are very simple. Are you all are able to find the answers? Yes or no? Because we have already understood the basic concepts in our chapters which we have done, right? So once you are very clear with the basics of these kind of subjects like economics, no question remains tough or hard for you. Okay. Any queries? I'm waiting. Is there any doubt from today's session? Otherwise, I would end it here, and we'll meet in the next session. Also, one thing which I wanted to tell you, that in the editorial analysis classes which we are doing daily, so today it didn't happen because there was no economy or finance related article in your Economic Times, Business Line, Hindu, Indian Express, any of these newspapers. Okay. So don't worry about it. You didn't miss anything today. It was just that there was no such article or major news in any of these newspapers. That's why the session did not happen today. One more thing, that in all the editorial analysis classes, I get the comments for PDF. Okay. PDF of the presentation. So let me tell you that PDF of every presentation is available after the class in your Telegram group. Okay. You can join the Telegram group, and it has also been pinned in your 23rd May class. You can refer to 23rd May editorial class. It is pinned over there. You can join that group and the PDFs will be available to you. So this is something which I needed to tell you, and I hope there is no question, no doubt. So thank you so much for staying focused, staying tuned. I'll meet you in the next session, which would be editorial analysis tomorrow. Okay. Yes, Phillips curve is important for every exam, right? I had one request to make. It's a bit overwhelming to cover the static part. Can you please make a roadmap to cover ECO for SEBI and IFSCA? See, for SEBI, I'm already teaching you SEBI economics in the paid course. Okay. According to weightage of the topics. All right, I'll try to do so. Okay. I'll try to do so. But for SEBI, I'm already teaching you the chapters which are important in the paid course. Okay. So I'm taking up the SEBI economics right now. I'll consider your request. And even if I forget, just remind me. Okay. So sometimes I forget as well. Telegram link, you can find it in the 23rd May editorial analysis. Okay, it is pinned there. That was it for today. Thank you so much. See you next in the session, which is to be held tomorrow, editorial analysis. Till then, have a very great day. Thank you so much.